Hi, I'm Ed Fulbright, CPA, CGMA, PFS of Fulbright Financial Consulting, PA. We would like to welcome you to our educational briefing.
Since the global financial crisis, the Federal Reserve has been conducting an experiment with the U.S. economy. In 2008, when short-term interest rates fell to zero and the Fed was out of conventional tools for stimulating economic growth, the Fed resorted to quantitative easing. Quantitative easing has been tried a few times before in the last 2 decades, but never by an economy approaching the size of the U.S. The Fed bought massive amounts of long-term government-backed bonds, which kept long-term interest rates low while increasing the money supply and stimulating business activity. The Fed balance sheet has ballooned from $869 billion in August 2007 to more than $4 trillion in June 2017. In 2010, when quantitative easing was just getting started, James Bullard, the president of the Federal Reserve Bank of St. Louis, said the Fed was in uncharted waters and warned that quantitative easing has its risks. If offsetting policy actions are not taken in a timely fashion, Bullard said, the increased monetary base will fuel a sharp rise in credit and inflation. The experiment has worked, and the Fed easing program prevented the Great Recession from becoming a depression. The economy is back to normal and now on a stable growth trajectory, but the experiment isn't over. With the June 14 release of the Fed's forecast for the economy through 2019, the quantitative easing program entered a new phase. Now that the economy is back to normal, the Fed is going to start unwinding its huge inventory of long-term bonds, which will raise rates and hurt bond prices. The unwinding is expected to take years and is a delicate operation because the Fed could make a mistake and accidentally trigger a recession. All U.S. recessions since World War II were triggered by the same policy mistake by the Fed. The mistake occurs when the Fed pushes long-term bond interest rates too low versus short-term yields. The differential between short and long-term rates is known as the yield curve. When the yield curve declines to zero and is flat, which is when long-term and short-term rates are the same, or the yield curve turns negative, it causes a recession. Going forward, this is a key data point to watch. If the Fed gets too aggressive unwinding its massive inventory of bonds and flattens the yield curve by raising short-term rates too much or selling bonds so fast as to make long-term rates fall too fast, it could cause a recession and a bear market in stocks. On June 14, the Fed raised short-term rates 0.25 point to a range of 1% to 1.25%, and its forecast calls for raising the short-term Fed funds rate to an average of 2.9% in 2019. With commensurate hikes expected in long-term rates, the outlook for long-term bonds remains poor. For fixed-income investors, riding the rising rate cycle will mean keeping maturities short. The Fed's latest economic projections offer a glimpse into how the Fed expects the unwinding to go. The Fed on June 14 raised its March projection for growth in 2017 from 2.1% to 2.2%. The unemployment forecast for 2017, 2018, and 2019 was lowered by a smidge, and the inflation projection was dropped from 1.9% to 1.6%. These projections are determined largely by the Fed funds rate, which is how the central bank controls short-term interest rates and where the central bank's policy meets the economy. For 2017, the Fed set a Fed funds target rate averaging 1.4% for the year, moving it up to an average of 2.1% in 2018 and then to 2.9% in 2019. No one can call the stock market, and we could experience a 10 or 15% correction at any time. But it's important to note that even after the Fed hiked rates, released its latest detailed projections, and gave the market a detailed glimpse into what's ahead, the S&P 500 stayed near its all-time high. Investors have confidence in the Fed's ability to successfully complete this historic experiment using new tools for managing economic cycles. That's progress for civilization.
Thank you for listening. Please contact us with any questions, and also contact us if you're interested in our complimentary second opinion on your investments or to set up a meeting regarding your wealth. Don't hesitate to share this video with people who might benefit from our work. Thank you again, and have a great day.